All right, welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Really excited because today we are revealing our Surprise of the Year award. Cue that alarm bell or drums. It is General Motors, ticker symbol on Yahoo Finance, GM. Make sure to check out all of our exciting General Motors coverage. It's going to be plastered all over Yahoo Finance homepage and our app. Watch our extended interview with General Motors CEO Mary Barra on YouTube. Great place to catch up on the Yahoo Finance content. Listen to the full interview wherever you get your podcasts. And last but not least, check out all our coverage by scanning the QR code to go to Yahoo Finance. Before today's interview, we have to get a clip running immediately with my conversation of General Motors CEO Mary Barra, where we talked about her surprising year. Take a listen. You put a real flag in the ground many years ago, Mary. Said we're going to be making all electric vehicles by 2035. Is that still your North Star and your hope?
Well, we still have a plan that allows us to get there, and so we're still executing to that plan. But the most important thing, and I've been saying this for a couple of years now, is we're going to be guided by the consumer. We want to give the consumer choice. What do they want to drive? We don't want to get into a situation where regulations are driving us to force something into the market that's not what they want. But I think once people start to drive an EV, they realize it's instant torque, beautifully designed. At least General Motors vehicles really give them a lot of technology in the right segments. And then not having to go to the gas station and the benefits of EVs, I think is something that people are going to move to because it's a better product. What we need to do to accomplish that, though, is to have a robust charging network. And that's what GM Energy is working on with a number of partners.
And that was GM CEO Mary Barra really talking about how the company made its magic this year, surprising on financials, surprising stock performance. Let's keep this chat going with B of A analyst John Murphy. John, good to see you again. Welcome back to the small table.
Great, thanks. Very happy to be here.
Yeah, so surprise of the year as an analyst covering General Motors. What has surprised you about this company?
Well, I think as we're kind of discussing a little bit before, it's really the consistency of earnings. I mean, we started the end of last year with an outlook for EBIT and free cash flow, and they have slowly walked that up through the course of the year amidst an environment which has not necessarily been that fantastical for volumes. It's been good for pricing, but not that great for volumes. And as we kind of went through the year, they've kind of walked that up to about 10%. The EBIT forecast right now, or the outlook, has a high end of $15 billion. It seems like they're going to hit that this year. Free cash flow is $13 billion, or potentially more. We'll see when we get the final numbers. And those, after covering this name for 25, 26 years now, those are fantastical numbers. Those are the kind of numbers you would dream of.
Is this the best financial performance you ever seen? In your 25 years, you ever seen it before?
Without a doubt, as far as the earnings and the EBIT and the free cash flow, we're going to be at record levels. 2021, 22, there were some real bumps from pricing on the COVID supply shock, but it'll be at that level, and that's a level that nobody thought would ever be consistently hit. And it seems like they may be hitting that for the next few years. It's really, the financial performance and the steady walk up has been very impressive.
Is it, well, every time I talk to GM CFO Paul Jacobson, we're always talking, I went back and looked back and listened to our interviews. I'm talking about cost cuts. Every time I talk to him, billions in dollars of costs out of their operating model. And I think that is what has surprised me. Where are they finding these costs?
So I would say this is an exercise that probably started when Mary took over as a CEO at the end of 2000. Mary Barra at the end of 2013, beginning of 2014, and it's a long recognition by Mary through the organization that you really need to strengthen your core and make the core business that much stronger, so you can fund the future. And this gets into sort of their investment in Ultium and ultimately autonomous tech. And that really is something that has kind of bled through the organization and actually is sort of a consistent thing year in and year out. Now, Paul has refined that, has worked on cap allocation, so there's been a little bit of a refinement and acceleration of that more recently. But in a large company like this, this kind of cost cutting is possible. In addition, they're making some strategic moves to pull back on investment in autonomous, a little bit on the battery side, because the market is not there for EVs, which will potentially enhance on top of these base cost cutting efforts, earnings and cash flow in 2025 and beyond.
I was talking to another analyst, and his contention was that you have to be in the autonomous vehicle game. I mean, just what GM announced on Cruise would suggest to me they're putting that technology into Super Cruise in the cars that they make, but they are ceding potentially the market to a Tesla and Uber and whoever else might want to be in that space. Is that the right play?
So they're not completely walking away from it. They're pulling the Cruise staff in-house, some of the technology in-house, and they still believe it's very important for personal transportation, which ultimately means if you get it right on the personal side, theoretically it could bleed back.
I don't want this in my next Corvette, John.
Into the commercial side. You don't want it in your Corvette.
Okay,
no, I mean as a car guy, autonomous is kind of the antichrist in a way.
I want my hands on those wheels.
Exactly, and you want to drive really fast. But there's a very important distinction there. I mean, their view is that your car can be autonomous when you're stuck in BLIE and in traffic.
Worst highway.
Or worst highway ever, and you really don't want to be driving in that kind of condition if the car can handle it autonomously. But when things clear out and you want to drive really fast and dynamically, you could do that yourself. So I think they're taking sort of a hybrid approach to this, but if they get it right, I do believe that they have an opportunity to go to a robo fleet, even though they're pulling back on that right now.
So so I went back, Cruise lost through the first 9 months on an operating basis almost $2.1 billion. I mean, that's a large sum of money. So get that business out of the way. They've also made a decision to streamline or rethink their China business. Like as an analyst, you're thinking, wow, they're finding more places to cut costs. Is 2025 another year where this company's still cutting billions of dollars out in costs?
I think there's a good chance, and I think there is more to do. And I think Mary's made some pretty big strategic moves in the past that I expect to occur in the future. So she did exit Europe, I think it was in 2016 or 17, which was 1 million cars. So when you're looking at a global scale game, walking away from 1 million units is a little bit scary, but it was absolutely the right decision to make. And I think there is the chance over time that the rationalization and restructuring of China ultimately means an exit of China.
Exit completely from China.
Exit completely over time. I mean, the industry is so heavily domestic, no matter where you are around the planet, that the rise of the Chinese automakers, I think, is going to make it difficult for international players to have a real strong position there.
Does it make any sense for GM and Ford to even be international? And I would compare it to what I've seen from Walmart the past decade. They exited, their UK business. They've streamlined where they are. Why not just be a US player and do EV well, do hybrid well, do things better, grow your margins in the US?
So I think it's a very important question for everybody in the auto industry, and this gets into our whole core to future thesis. The reality is, in the global auto industry, automakers have never made much money, in anything except North American trucks and global luxury. The reality is, GM and Ford don't have necessarily the greatest global luxury platform to work with. Cadillac and Lincoln are okay, but the reality is their bread and butter, and this is the same thing for Stellantis, is North American trucks. So I think a retrenchment, certainly for now, to North American truck business and their North American market is something that probably would make a lot of sense for these companies. And if you're looking for true mid to long-term value creation, that earnings and cash flow probably could grow over time and be even stronger, fund your future, fund your buybacks, and you could create a lot of shareholder value. So yes, I think it's something to really consider because the rest of the world is really not a profitable business for almost anybody, and certainly not for GM.
For the record, I just want to say I really enjoy my CT4 Blackwing. I mean, that is a damn good car, John. Thank you, Mary Barra.
These are companies that make unbelievable vehicles when they can focus, and certainly they make unbelievable powertrains, both on the ICE and the EV side.
We're sitting here talking about cost cuts driving the stock. Well, GM sure seems to have hit its product stride. Every time they report earnings, this, they have in their slide deck, they have these big, beautiful cars they rolled out in the quarter, and trucks, of course, new things coming next year. The quality, as someone that recently shopped to get this Blackwing 6 months ago, I was surprised by the quality I saw in these. The infotainment center, the leather, the fit, the drive quality, the technology. It's like they got their product mojo back.
Yeah, I mean, they really are top-notch product. I would say that as we look at right now, they have the mid-size and smaller crossovers that are launched last year and next year. Importantly, when we get to calendar year 27 and 28, they have their pickups and large SUVs, which are an unbelievable franchise, which nobody's been able to crack.
Still high margin for them.
Incredibly high. I mean, it's where the entire profit of the company is largely baked. So I mean, on top of that truck franchise, they have a very good crossover franchise right now. You hear from the dealers, the Trax is actually doing fairly well, a very low-priced entry level price. Nice. For what it is, it's a great product.
Not sold on the new Blazer. My dad had a '99 Blazer, so I have this image in my head of what it should look like.
That's a relic.
It is a relic, but the new one looks like it's small. Like, I don't know. I'm a car guy. Jay, you're a car guy.
They're slightly different. They're slightly different products, but they're for they're the mass market, the people that need transportation, and they're a very good product for folks. So they have those, and they have the truck franchise. Now in the middle, they have a very robust EV launch schedule, which unfortunately, particularly in the U.S., the market is really not there for that right now. And with probably the stripping down of the IRA incentive of $7,500, it's going to be really tough to drive those vehicles and even build scale here in the U.S. So we're in a tough spot on the EV intros, but subjectively, I should say, from my opinion, their EVs are very, very good. It's just the market is just not there for them.
I picked up on this thread from someone I was talking to. They're on the auto space. They are of the view that President Trump will roll back emission standards, might elongate the useful life a lot of these assets that a GM, a Ford has in the market. Are you of that view, and what does that mean to the bottom line of these companies?
Well, absolutely over the next 4 years. EVs are challenged even with the $7,500 credit. So if that gets pulled away, and the emission standards get the carrot and the stick both go away on EVs, the reality is these ICE assets and these ICE vehicles have a lot longer to run. And if you think about the cash flow that's being generated in 24, and with a likely relatively similar performance in 25, and our view of the cycle peaking in 28, we kind of have a great 4-year run in front of us of the cycle and powertrain tech and their products hitting stride. That you're looking at almost a 25% free cash flow yield on the stock right now, which means if you're pretty aggressive on buybacks, which they are, that you can almost buy back the entire market cap of the company over the next 4 years. I mean, it is really, this setup is really pretty amazing for the stock, and I think the elongation of the cash flow and earnings from these ICE assets is a very important part of it.
I get it, but then I don't get it. So I encourage everyone listening to this, or if you're watching us on Yahoo Finance, pull up GM's ticker page, go to the stats page, and you'll see GM's 4P ratio about 5.5, 6 times, despite the broader market trades at 23 times. This is a company that surprised all year on earnings, cash flow. Why that steep discount relative to the market when they have proven that they can grow?
So there's a lot of skepticism as to terminal value, particularly as you see sort of a pullback on autonomy, and you see the rise of the Chinese manufacturers globally. So there's definitely some concern there, and then there's concern, with Tesla being very proficient on FSD and EVs, obviously, as their core hardware entree into the market. So I think when you look at this, the stock has historically traded about 9 to 10 times PE, 4 to 5 times EV to EBITDA. It's far below that, as you mentioned right now. We have an $85 price objective, which is 4 times EV to EBITDA, which is kind of at the lower end of the historical range, and about 8 times PE on this year's numbers. But it's far lower as you kind of go forward as the earnings and cash flow grow. So I think there's extreme skepticism as to their sort of long-term future. But once again, if you can buy back your entire market cap in the next 4 years from the cash flow you're generating, you got to imagine you have a pretty good financial instrument, no matter what you want to call it. And the stock is very interesting here.
All right, hang with us, John. We're going to be right back here on Opening Bid. All right, welcome back to Opening Bid. Yahoo Finance awarding General Motors our surprise of the year. Talking with our favorite auto analyst, Hall of Fame analyst, I should say, John Murphy of B of A. Good to see you here back at the table here at the NASDAQ. I want to lean into this wonkiness. We're talking P multiples and ratios and data. I love this stuff. So why not assign General Motors a market multiple?
Well,
or 15 times. So you're still at a discount. I mean, clearly this company, even if you don't believe in their growth, they're outputting, to your point, a lot of cash. They're buying back just a ton, a real big slug of stock.
So I think getting to sort of the terminal value, but then also the sustainability of the earnings and cash flow. Okay. We are in an incredibly cyclical industry that happens to be below sort of trend levels, at least in my opinion, on volume. I think we may actually hit 18 million units in 27 and 28. So I think there's a tremendous amount of upside to the cycle. And I think the extreme fear of pricing collapsing and price discipline collapsing in the industry is certainly way oversold. And I think the reality is the earnings and the cash flow that they're generating right now are at least sustainable, in my opinion, for the next 4 years or so. The question is, on the downside of cycle, what will actually happen to these earnings and cash flow?
We're going to be retired by then anyway, John. So anything can happen.
Hopefully, just retired and still standing, right? That's we don't
want to see the alternative.
So I think that's the concern with the stock.
news comes out, let's say January 21st, President Trump, hey, we're ripping out the tariff hammer. Explain to us what the impact of that would be on, it's a General Motors, it's a Ford, these companies have assets in what, Canada, Mexico? Like,
Yep.
what is, as an analyst, what do you do to your models? What do you tell your clients? What do you tell the associates on your team? How do you think through this?
So first of all, we need to understand exactly where the tariffs are coming, right? I mean, if they are tariffs to close off North America to outside competition, particularly new entrants being the Chinese manufacturers, that's actually a net positive. If you start getting into the tariffing significantly of product between flow on parts and then vehicles, I mean, almost a third of GM's vehicles are coming from outside the U.S. or mostly from Mexico in North America, that creates real problems, right? And there's a question of how fast you can react to that. You don't have a lot of extra capacity in the U.S. To move. They have a truck platform or truck plant in Silao, Mexico. That's very important for their pickups. So they can't just pick up and move. So you're going to have to figure out how to deal with that. Now, a 25% tariff on the flow of auto parts and autos from Canada and Mexico is unlikely to fully come through. But obviously, when the president says stuff like that, you really need to pay attention. I think that is a negotiating tactic, and I don't think we're going to have to deal with stuff that's that extreme. But the reality is, there'll be a tightening of rules of origin of product coming in, particularly from Mexico, so it's not a backdoor for Chinese product and vehicles to come into the U.S. So I think there may be a tightening of the rules of origin, potentially a ratcheting up of the 2.5% tariff of the products that don't meet those rules of origin. So there's a little bit of risk. I think the reality is going to be a net positive for the domestics, and potentially even some of the companies like the Japanese and the Koreans that are heavily focused on the U.S., and it would be good for Tesla as well.
Does it cause a rethink inside of the C-suite of the big three? To your point, you can't, so tariffs come out January 21st after inauguration, you can't build a new car making factory overnight, but does it cause a rethink in the industry? Maybe we're just not in Mexico anymore. Maybe we do put some capital to work here in the U.S., or more capital to work in the U.S., and just go all in on the U.S.?
So the reality is labor costs would make that largely prohibitive, and there would kind of be a very significant question of how much if you were going to do that, how much you would actually be able to automate to bring down the manufacturing cost down. So it would be a pretty significant, it would be a very significant decision and tough to really make. Plus, because you are thinking about product cycles that are 5 to 6 years, and then an auto cycle that's 5 to 10 years, 4 years is somewhat of a short time frame. So really ripping up the business for something that may be a four-year policy is really difficult to do. So it's going to be, it's going to be a real dance, and they're going to have to figure out how to deal with this. And I think they're going to have to figure out how to lobby so that you don't get that, don't get those extremes in place. And the reality is, for the auto industry specifically, forget about talking about the country more largely, is you want to create sort of a cohesive North American supply chain that's ready in place, and really foster that and bring Canada and Mexico into the fold, as opposed to, I think, beating them with a tariff stick and pushing them into the hands of the Chinese. Because the last thing we really need is a large auto presence, specifically speaking about autos, in Mexico that could potentially come across the border sometime down the line.
Do tariffs mean higher car prices for people?
Yes. Simple answer.
Big increase?
I mean, it depends on what the tariffs are, but I mean, we just had a conference with our dealer coverage last week, and that was sort of clear that the dealers believe that the pass-through on increased tariffs, which would mean that their prices would go up, that would get passed directly across to the consumers. Or at the point of sale, the folks actually transacting are saying the large majority of that's going to go.
I can barely already afford a car. Like, I mean, everything's going up.
It's wild, yes.
Are they stocking up on inventory now, ahead of potential tariffs?
At this point, there's no active stocking up, but you could certainly say Stellantis and Nissan have a natural mistake that that is, or not a natural mistake, an unnatural mistake that's occurring right now on excess inventory. But no.
What happens to Stellantis here? Really struggling.
Well, when you look at their product cycle over the next 4 years, it's tough. When you look at their current inventory levels, it's tough. When you look at their product offering, I was looking at a Jeep Rubicon 392. And we all know that their pricing is way too high. But when you look at it on a personal level, it was $106,000
for a Jeep.
For a Jeep Wrangler.
Are you kidding me?
There was that was my reaction. Their trim and pricing is so far out of whack that it's going to take a while to work down the existing inventory, and then you have a 4-year, at least a 4-year gap in product introductions. The incoming CEO, whoever that is going to have at least a 5-year program in front of you for them to turn this company around. So
can that fly? Can that Jeep fly? Could it climb up rocks?
I mean, for $106,000, you'd want it to do that and serve you breakfast too,
yeah,
right?
I would have used Porsche for that or something.
Yes, yeah.
Looking out to, next year, what do you think will surprise investors by General Motors?
I think you will continue to be surprised about the consistency in earnings. So I think that's the first thing. I think the second thing, there is often with product cycles a lack of recognition 2 to 3 years out about what's to come. And I think sort of a reminder that they've got this great truck franchise which is going to hit pay dirt again, which it does consistently and it will do next year with new product in 26 and 27. And I think the willingness to continue to take your free cash flow, balance sheet's in great shape, and just continue to buy back shares. So I mean, they'll probably buy back another 20-25% of the company next year, depending on how high the stock goes. And I think that will keep bringing people in. And I think that that really is the ticket for this stock. You
mentioned Tesla a couple times throughout. You recently visited a factory. For those that have never done that before, what is that like? What are you looking for too? So we went to Giga Austin, and it was pretty impressive. I would say, as far as the factory itself, what was actually more interesting was being in a Model Y with version 13.2 FSD. And that was the first time we'd been in that because it had just been released 2 or 3 days prior, that version. And the ride, the handling, the complete lack of intervention by the safety driver who was in the car with us. We took I was in it alone with the safety driver. We took an unprotected left turn in front of a semi at an intersection on an interstate, and it was rightfully aggressive, but made it through, and there was no issue. Where I think you would look at other semi-autonomous or autonomous systems that definitively would have waited. And not, it was safe. It was perfectly safe. So I think there are many things about the ride and handling and how fat and sort of the characteristics of the vehicle under this semi-autonomous drive on FSD is an indication that they are moving very, very, very quickly in a way that I think a lot of folks don't necessarily appreciate. That's why we talked to John Murphy. And this guy, he's got his sleeves rolled up, visiting factories still. This is why he's our favorite. And to that end, John, we love to ask folks for their hot takes in the last minute and a half that we get. As you look to next year, what's the 1 or 2 cars you're most jacked up about, that you're just excited to see hit the market? Maybe you're not going to buy them, but you're like, wow, that's a nice car. So I think despite being a gearhead and loving V8 twin turbos, I think a lot of the EVs that are coming out, and I think probably the most important. Oh, they got you, man. Oh. I think one of the no, not necessarily from a personal standpoint, but important for the market is going to be the entry level or the derivative of the 3 and the Y that the Tesla is going to put out. All right, well, good to see you, John Murphy, as always. Thank you for making time for us. We really appreciate it. Great, thanks for having me. All right, make sure to check out all our General Motors coverage. Of course, they are winning our Surprise of the Year award. Watch our extended interview with General Motors CEO Mary Barra on YouTube. Listen to the full interview wherever you get your podcasts, and be sure to check out all of our coverage by scanning the QR code on Yahoo Finance. Lots of places to find our Surprise of the Year award, General Motors. That's it for the latest episode of Opening Bid.